everybody. I hope you are having a great day, and I hope you had a great summer as well. I thought I'd get on here and do another market update video. It's been a few months, and we're starting in October now, and we have a little bit of volatility. And interest rates are spiking, and this is the highest they've been in quite a while. So let's dive in and see what's going on. So yeah, the market's been off to a rough start in October and September. NASDAQ was down about 6% last month, and we've got the interest rate spiking now. You can see we're at 4.792 today, and it's kind of been a parabolic spike, just coming up here very quickly. But if we look at a year to date, we can see this spike right here has been pretty dramatic. And anytime you get a spike like that, it causes people to panic, and it causes a lot of disarray in the markets. So the main reason why it's happening is the same thing that has happened in the past. The Fed, people are expecting the likelihood of raising rates is going to be higher than it was a couple of months ago. That's primarily due to this spike in oil prices that we've had over the past several weeks. And that is mostly due to the Saudis, who have cut back on their supplies, and that has resulted in increased prices. So I think the oil price now, it's kind of in the range where they like to see it. So it could trend down if they make a decision to back off of their supply in the next OPEC meeting. But the Fed did not raise rates at the September meeting on the 20th of September. And they really cited the stronger economy and stronger economic activity for the reason why. Just on October 2nd, just the other day, we got the PMI, which is Purchasing Managers Index, and that was a little bit below, or it was a little bit above what expectations were. So it was 49.8, and the forecast was 48.9. And this is another example of the economy is doing a little bit better than they expected. They raised rates with the expectation that the economy would slow along with inflation, but it continues to be resilient. And however, we did see unemployment tick up recently to 3.8%. The industries that had gained jobs were leisure and hospitality, social services, travel, that sort of thing. Construction as well. There's a lot of construction going on. The industries that are not doing as well, transportation and warehousing. And that makes sense when you think about it. I think that consumers are really beginning to feel the bite of the inflation and the higher pump prices, and the propensity to buy higher ticket items such as cars and household appliances and homes. It's much, much lower than it has been at any point in the past several years. And that makes sense. I think consumers are finally spending all the money that they had saved up, and it's starting to be painful. So yeah, so the odds of a rate hike have increased, and this is a great thing to see here. So this is for the November meeting. We're expecting 67% chance they're not going to do anything, and rates will stay where they're at. But there is, a 33% chance that they will do that, and it has increased recently. So we have growth softening a bit. The dollar has been quite strong, which is something that's normal to see when you have high interest rates, and we have oil prices up. Most people's goals are longer out than just 1 year, and so it probably does make some sense to add duration, because if rates do come down, that 5% money market rate will come down very quickly. And if you have some long-dated bonds in the portfolio, you can lock in the higher 5-6% interest rates, even as rates go down, and those bonds will come up in value. So it's important to look at the big picture and keep some of those in your portfolio as well. Let's take a look at the technical analysis, what's going on. So you can see here we have a long-term support going back to September of last year, so basically a year, and it's still intact. This green line's still intact, and we think that we should bounce off at this level of support and continue to go up. However, we're in the middle of a pullback, and this is kind of where you get the most divergence in people's opinions, because we could go up or we could go down, and it just kind of depends. But so far, this line is holding. There's a similar setup for the NASDAQ and the other indices. Here's the NASDAQ. It's a similar thing, except the NASDAQ's been much stronger than the Russell or the Dow. You know, the Dow, which is just 30 stocks, not many of the tech stocks, so it's not really driving the market as much as the S&P or the NASDAQ. But the Dow and the Russell have just been weak, and that has to do with, again, with rates. Every time rates spike, those indices do poor. And the Russell, again, is the small cap index. So, you know, with higher rates and smaller companies needing to borrow more money, they're perceived as not is good for a higher rate environment. That's what I have, and I think it's important just again to remember that to have a long-term view and not get too bogged down in the details. You know, your goals are likely several years out, and you need to be patient to get through times like this. If you have any questions about any of this content, feel free to give me a call. Hope you have a great day. Thanks a lot.